Everybody, Bob Iaccino, co-portfolio manager of the Stock Think Tank, of course, with Mike Arnold. And Mike and I just spent a good hour and a half, maybe 2 hours, looking at different stocks and struggling to find things that fit our value scans. Again, if something is overdone, overbought, doesn't have value versus its sector, doesn't have value as a standalone active investment, we're not going to look at it. Since the beginning of April, we've exited, I believe it's 10 stocks. And we have 3 left. 2 of them are special plays. They're not even in the core portfolio. Checkpoint Software is our last one in the core. Looking at it from that perspective and see how hard it's been to find these stocks to get new trades put on tells us something. And we're going through a stretch of down moves for the markets. And I've mentioned this in videos before, that when we start to exit the portfolio, our process is almost predicting that there's going to be some weakness in the markets because things are overdone. We are not the only ones. We're not acting like we're geniuses here. We're not the only ones that are struggling to find things that have value. So as buying dries up, weakness comes in. But I don't really want to talk about that right now. That's just an explanation for some of you who are looking for trades from us. You're not getting what you thought you'd expect. We're not going to give you bad trades. It's just not something we do. But let's talk about just a general economic principle right now, and that's the principle of inflation, which I've been talking about a lot. I've been saying it's coming. I've even been saying it's here. The Federal Reserve thinks that it's transitory. That's the word you keep hearing, is transitory, meaning it's a transition price increase that's going to go away. I don't know if that's the case because the thing that's been missing from inflation has been wage pressures. With the stimulus that people got, I'm not saying if that was a good thing or a bad thing, we now know, given the non-farm payrolls number that we just received, given the JOLTS job numbers at a record high, job openings, there was over 8.5 million jobs open according to the JOLTS survey, and 44% of small businesses not being able to hire the employees they need. We're hearing anecdotally of $800 to $2,000 bonuses for restaurant workers just to sign on. There are individuals who are not going back into the labor force. So whether you want to say it's because of the stimulus payments or because their jobs are not worthy of their time, doesn't really matter to me as an analyst. What we're seeing is companies are going to have to start paying more if this added stimulus to the individual who's out of work continues. It is a forced price hike. It's a forced higher minimum wage. It's not going to be legislated. It's getting forced. We already saw mandatory price increases for the lower levels from Amazon, from McDonald's. There's been many more. But what this does is it kills the small businesses that can't afford to do those price hikes. A place like McDonald's can. A place like Amazon can. Now that can potentially slow job growth in the future. So it feels to me like we're borrowing from the future. Now, the inflation story can actually pick up steam as these wages grow because wages are still 70% of the cost of goods. So if wages start to go up, it has an exponential effect on prices. How the Fed can think that's transitory, I don't know. I could be wrong. There's another thing, that real yields are a problem for the Fed, but it's a good thing for precious metals, and we actually own silver in the special plays. Real yields on May 14th of last year were negative 40 in the 5-year sector. That's negative 40 basis points. So just short of negative 0.5%. 50 basis points would be 0.5%. And in the 10-year sector, they were negative 43. On the close on Friday, the 5-year was negative 1.86%. More than 4 times the actual number that we're seeing right now. The 10-year was 0.88 to the negative. So more than double what we saw at this time last year. Those are negative yields in the United States, negative real yields. Those are an issue for the markets. They're an issue for stocks. And until stocks pull back to a reasonable level where our value scans start spotting everything, expect a little bit of quiet from us. I will talk to you guys in the next update. Just wanted to give you that sort of macro concept so you can mull it over, talk about it at cocktail parties or at the dinner table. See if I'm wrong. I don't think I am. Cheers, guys.